If we say last year outperformance by the international markets, I think another year or even two could well be on the cards.
Don't look now, but U.S. markets are underperforming the rest of the world. We go hunting for opportunities with a veteran emerging markets investor. Everyone thinks emerging markets may be BRICS.
Oh, please don't use that acronym anymore. Now, if we're talking emerging markets, China, Taiwan, South Korea, and India.
Matthew Strauss is a portfolio manager and leads global equities at CI Global Asset Management. With more than 32 years of emerging market investing under his belt, he says it's a market that has matured a lot. Do you think that global markets, emerging markets, are in for a period of sustained outperformance? How do you explain why global markets are doing better than U.S. markets?
With Labubu, we've reached peak growth.
Peak Labubu.
Yes, I think that's where we are.
When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof. From tax and estate planning to trust services for generational wealth and strategies for life's key milestones like buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James advisors unique is their complete independence. With no proprietary product to promote, you will benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $100 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. The content provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult with a qualified financial advisor or professional before making any investment decisions. This episode features a portfolio manager from CI Global Asset Management, which is one of our sponsors. Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. Today is going to be the final episode to vote on our next swag giveaway. We have been collecting your ideas. They were brilliant on what we should put on a mug or what we should put on a hat. And now is your final opportunity to vote on the best idea. Will it be the liquid assets mug, the free Jerome Powell mug, which is the one I'm secretly rooting for, not to bias the voting pool, or the market cap hat, which so far I must say is pulling ahead. So have your say wherever you're listening. You should find the link in the show notes. And in the next episode, we are going to reveal the most popular items, and that will be our next swag giveaway. Okay, on this episode, we are talking about global market opportunities. You know, in Canada, we are a little bit myopic. We look at our own equities. We look at U.S. equities. Maybe we put a little bit of Europe in the portfolio. But now more than ever, it is important to look at what is going on with global markets, especially weaning off the addiction of U.S. stocks. Consider this. A recent Bloomberg analysis showed that out of 92 global markets so far in 2026, the U.S. ranks 69th. Terrible returns compared to where we can get elsewhere around the world. So we've got Matthew Strauss of CI Global Asset Management, and he has been a emerging markets investor since the 90s, when it was the Mexican crisis, the Russian crisis, moving from one crisis to another. He's worn it all, but we're also coming to a point in time where all those markets, maybe not Russia, but most of the emerging markets have matured when it comes to the liquidity in the markets as well as corporate governance. So we talk a lot about what's driving global outperformance today, whether it's sustainable, and as always, what are the best places to invest right now? Let's get into it. Matthew Strauss, thank you so much for joining me on the podcast.
Oh, thank you for having me.
I'm so excited to talk to you about global equities, not just because they're having a moment, but it's, we're in Canada. We talk a lot about Canadian stocks. We talk a lot about U.S. stocks just because that's what's around. And your job is to hunt for those opportunities around the world. And before we get into that, I just want to know a little bit about you and your background. How long have you been an emerging markets and a global fund manager?
For emerging markets, kind of my whole career. That started back in 94. So it started with that Mexican crisis. So not exactly the right time to start with emerging markets, but that's where I've been following emerging markets, and then slowly morphed into some of the other asset classes also on the currency side. And then I joined CI in 2011. And it was really since joining them that I've started looking also at global equities as well.
It's so interesting when you mentioned the crises, the Mexican crisis. And I feel like for a long time, that was kind of people's emerging market experience, was moving from one crisis to another. What is different about emerging markets today versus when you started in your career? Has there been a maturity in the sector and the companies that you meet?
Absolutely a maturity. I mean, I think if we look at emerging markets in the late 1980s and then throughout the 1990s, you're right, every few years there was some kind of crisis, whether it was the Mexican crisis, then the Russian default in 1998, and then early in the 2000s we had the Argentinian default and the Brazilian crisis and the South African rand currency crisis. So it was literally stumbling, and then you've got like 2 good years and then there's another stumble. And if one of those markets go under, it drags sentiment down for emerging markets as a whole. Since then, they have really grown up, both in terms of policy making, fiscal policies, how they manage the fiscal side, but also on like currencies. Most of these emerging markets now have free floating currency, so allowing the currency to take a lot of these shocks. So if we think about it, I think 2008 was a really good example. We came through 2008 with developed markets going through a deep, deep crisis. Not a single at least of the bigger emerging markets, went through a deep crisis. And then since then, there hadn't really been a deep crisis. Again, there are a few exceptions. Argentina would be an exception. Turkey would be an exception. But if we take the majority and the larger, mature emerging markets, they haven't seen a crisis similar to what we've seen in the 1990s.
And have we broadened out, like, everyone thinks emerging markets, maybe BRICS, right? That acronym, Brazil, Russia, India, China, coined in...
Oh, please don't use that acronym anymore.
I know, so are you sick of the acronym?
Because Russia is not, it's out of the emerging markets, but even if it was, it would have been very low on the priority list. South Africa is emerging market, but it's really, really small. Now, if we're talking emerging markets, if we think China, Taiwan, South Korea, and India, that now represents 3/4 of the emerging market universe. So it has really moved away. The BRICS is still a concept that lives on, but has no investment.
Okay, so we've moved past.
Yes.
What should investors think about, buying Canadian, buying U.S. stocks? What does it take to be a good emerging market stock picker that's based in Canada?
Yes, I think it's very difficult because even us, we have boots on the ground in Asia. We have a Hong Kong office because you really need boots on the ground. If you're going into emerging markets, I think there's greater and more interesting opportunities because a lot of the companies are not followed nearly as much by brokers as we've seen in developed markets. But it also means that you have to go beyond the balance sheet, even beyond just meeting the management or IR of a company. You have to really lift up that hood and see what is below that. What's the competition saying about the company? What are industry experts saying about the industry? And then try to put that in context. So it's not just the company or just its financial. In the context of emerging markets, in a macro context, does it make sense?
You have to be worried about fraud too, to a greater degree.
Absolutely. Although I would be quick to add, less so than in the past. Again, if we talk 10, maybe 15 years ago, that was a real concern. Mm-hmm. Now we've seen most of the countries, including China, on a very aggressive way, have been pushing better and better corporate governance. So it's still an issue, but less so than 10, 15 years ago.
So now here we are, 2026, a couple months in, and we're sitting in a moment in time where you've always been looking for emerging markets and global opportunities, but it's been hard to get away from the dominance that is the US. Mm-hmm. Yeah. And then here we are, 2026, and the US is kind of a terrible market, globally speaking. there are many, many other markets, including Canada, that are doing better than the US right now from an equity perspective. How do you explain why global markets are doing better than US markets?
I think, and I wouldn't necessarily say the US market is terrible, but there is a moment here where investors, including ourselves, are more looking at outside North America for those markets. Because the US market, we've seen the US market pulling in capital in a very, very significant way, not only since Gen AI started coming through, even before that. So we ended up at the beginning of last year with investors being very overweight in the US and a US market that had become very expensive. And then if you start comparing it to some of the other markets, it just planted that seed. Why wouldn't you be in other markets that's cheaper for kind of maybe the same company, not on the technology side, but if we think about industrials, you might even get a better industrial name or a better bank, higher profitability at a cheaper valuation. And then we look at below that in emerging markets, it was a very deeply underweight market. And compared to the rest of the world, not only just compared to the US, a very cheap market.
So people were overweight the US, so they just needed an opportunity, right? Valuations were low enough globally to be tempting. But you also you do need a growth piece, right? Did that change? Or did the valuation just become compelling enough to encourage people to look at the growth profile?
I think it's a combination of both valuation, but also the growth piece is, especially if we think tech, how much is now priced in on the growth side. And if we think late last year, the big capital raises, and it's just going to be great how they build data centers, until we got to a point where the market became concerned, but you cannot just continue to borrow more money, spend more capex, and that will be the future. So there is a growth concern given where the market is trading. But then if you look at like emerging markets, suddenly you're also seeing underlying economic growth picking up faster than what we're seeing in developed markets. So we're seeing that economic growth differential between emerging markets and developed markets starting to widen again. And in the past, that had been a very important driver.
And that seems counterintuitive because we're looking at the US taking aim through its trade policy at all of these countries. And you would think that tariffs are actually going to dent the growth prospects of these countries, of these companies. Why isn't that happening?
Well, I think the one is that Liberation Day and what was said on Liberation Day and how it ultimately played out in practice, thank goodness, two totally different things. But also, if we talked earlier about how emerging markets have changed, if we go back to the 1990s, you played emerging markets, so you get a cheap export or manufacturing hub to export to developed markets. Or it is through the commodity market that you're playing the emerging market world. That have now very much changed, where yes, export's still important, but also important is the growth within emerging markets, their own consumer spending, their own financial sector are growing. And then as we see in Taiwan, Korea, and China, their own technology development. And that theme is then very much an emerging market theme, not totally independent from developed markets, but less dependent.
Now, you run a couple of funds. Some are specific to emerging markets and some are global equities. The global equity one is interesting because I'll note some of your top holdings look a lot like the top holdings of the S&P 500. They're still the big tech names. Help me explain your thinking there.
Look, if we think, let's take NVIDIA, for example. The AI theme, I think we are very deep believers in the AI theme is a strong theme. It's almost like the internet in the 1990s. It's not going to go away. There could be some different permutations, or in a year or two, if we look back, things might have played out slightly different than what we thought, but it is a very, very compelling theme. And therefore, we are sensitive to valuation and we take some profit and trim if we think we get to two extreme levels. But it will be a theme that we continue to be heavily invested. And from that perspective, the US and the likes of NVIDIA or Google, if we look at the Mag 7, we're not in all of the Mag 7, but those names will continue to be important holdings in the global fund.
So that's I think important, especially now to talk about, because a lot of them, they haven't actually come off. Let's use NVIDIA as an example, but they've just stopped going higher.
Yes.
What do you think that's about? Is that just a period of consolidation? And, contrast it with a Samsung, which I know is also in your fund. What do you think this is about? The fact that the Mag 7, which make up a part of your global equity fund, they're not falling, but they're not advancing.
It's interesting. Last year and the year before, it felt like investors were trying to pick the AI winners. And it was all about, and they just couldn't get enough of AI winners. Valuation was less of a concern, overcrowding, less of a concern, just buy the winners. And it became a big momentum trade. And I'm still concerned that we might get a bit of a correction on the momentum trade. But it is very interesting. Late last year, we saw the first signs of the market getting concerned, one, on the CapEx spending, if we think Oracle, but also starting to think who would be the real losers here. And that gained its own momentum as we came into this year. And now it's all about the losers. Where last year was about the winners, it's now the losers. Sell the losers, sell the losers. And it's rolling through one industry after the other. I mean, software being the poster child here, but then into the legal side, into travel platforms, if we think Expedia or bookings. So this is where we are now, is the market trying to figure out what the losers look like and what would be a right valuation for those losers. And the less focus on what do we do with winners. So the winners are kind of in a pause. And the losers are the focus at the moment.
And that's interesting. And before we dip into the mailbag, because we have a lot of international questions, one of those holdings that the market has decided is a loser is Microsoft. Do you think it is?
I think Microsoft in the end will turn out to be a winner.
Yeah.
I think part of it got swept up in sell software. All software companies are going to be losers. There's no ways that all software companies are going to be losers. Yes, there will be losers. There will be some that will be more intermediated by AI than others. But to just take Microsoft suddenly and treat it as a software company, I think that's an unfair characterization.
Okay, I'm trying to make this a global equity show, and then even me, I'm still talking about the Mag 7 and those large caps. So I guess old habits die hard. What do you think about the legs of this rally? And how long do you think, because these things do come in cycles, right? There can be periods of years of underperformance of the US markets relative to global markets. And I think that's a big question for investors right now. Do you think that global markets, emerging markets are in for a period of sustained outperformance, or is the jury still out on that?
I think we could, it depends what you call sustained, but if we say last year outperformance by the international markets, I think another year or even two could well be on the cards. And I think there are good fundamental reasons. It's not just positioning and valuation, but there are good fundamental reasons why I think these markets can outperform, especially if we were to look at emerging markets, and we can talk a little bit more in detail on that, but also Japan. I think there are things fundamentally changing in Japan, also on the corporate governance side, and basically forcing companies to look at investor return to become more profitable. So I think those are two regions, emerging markets and Japan, where I can see a longer outperformance of the US market.
Do you still see opportunities in Japan? I mean, the long story short of Japan is that it was a market that did nothing for 30 years, and then it woke up. It woke up violently. It is moving on to new highs, but only just starting that process. A lot of political tumult, but now in place is a spender, big spender, at a time where we're not sure what the central bank is going to do. How are they going to react to that? Japan, which has had never had to deal with inflation, all of a sudden has to deal with inflation. how do you think about what all this means for the investing landscape in Japan?
And interesting, it's one country that's happy about inflation.
Yeah.
Maybe the rise in inflation was a little bit too much last year, but they are actually happy to see some inflation because they were, as you say, for 30 years fighting deflation and trying to get out of this deflationary trap. Now, for them, yes, the election of Takaishi as the prime minister, really important. She is following her fairly fiscal expansionary program, and she's very adamant that is what she will be doing. So for the equity world, it's normally a good thing because that means you get more growth. More growth can be more earnings. Maybe you can expand margin, which we have seen some companies already doing. So for equities, it's really good. For the fixed income side, a little bit more problematic because Japan has a very, very high debt ratio.
Yeah.
But from the equity side, it looks good.
You think the debt market's going to play along with the spending?
No, I don't think they're going to play along. But we have one big player, and that is the Bank of Japan. They are a big player in the equity. In the fixed income. Well, they play in the equity market a little bit, but or not play. They've bought equities, yes. But they are a big player in the fixed income market. The majority of Japan bonds are held by the locals, so all of that makes it a little bit more stable. Less worrying that they are going to totally break this whole scenario.
Yeah. Okay.
So the other part for us on the equity side, if we look where she's focusing on growth, capital spending, cleaner energy, but then also on the defense side, as we've seen a number of countries doing on the defense side, but that all is creating investment opportunities from a macro side. And then there's the micro side, which I think investors often miss, and that is the government really trying to drive improved corporate governance, improved profitability for companies, and in that is unbundling of these conglomerates into more sensible companies.
All right. And we're going to talk a little bit about that as we make our way through the mailbag, because there's a bunch of Japanese questions, Japanese stocks that we got questions on. Let's dip into the mailbag. Okay, our first question in the mailbag is actually about Indian stocks. This question coming from Tim. Last month, I bought into an ETF of Indian stocks. Is now a good time to invest in India? It was a hot market. And I would say for the last couple of years, it has spent, really since 2024, consolidating around the highs.
Yes, and consolidating while the rest of the emerging market world were rallying. So
that's underperforming.
That's underperformance.
Yes.
Maybe I'll start off by saying, look, we are underweight India, and probably not what was it, Jim?
Tim,
Tim wanted to hear, but
well, no, explain it. Why are you underweight?
We're underweight, and not because we're concerned about the structural part. If we look at India structurally, longer term, over a 12, 24 month, we think it remains one of the emerging markets with the most potential. And if that's the case, and also from the equity side, I think there are great opportunities within the equity world for India. We just think right here, right now, it's in a cyclically more difficult spot. One is valuation-wise, it did rally very significantly. So it's one of the few emerging markets that's really overvalued, also in terms of its historical value. Because one could say, but India is always a more expensive market, but even compared historically, it's still a very expensive market. If we look at earnings expectations, yes, it had come down a bit. We think it's still too optimistic. And then if we look at flows, it is interesting. Foreign flows are kind of absent from the market at the moment. And then we've seen local flows that had been very significant the last few years through the increase in mutual fund flows into the equity market. That is also slowing down. So all of that tells us that right here is probably not the time to really go hard on India and overweight India. We still have a number of holdings in India, but it is more with a view on the longer term.
Now, how do you think about trade as it relates to maybe that longer term picture, maybe a U.S. desire to wean off reliance on China, shift some of that to India, trade agreements between the U.S. and India? Does any of that change your near-term calculus?
not so much on the near term. Again, it would be more a situation, how much can they take over some of the supply chain? And there's a lot of questions still around that. And that's where we get into the nitty-gritty and the problems on the Indian side, infrastructure, just-in-time delivery. Those are still things that are a problem for India, where you cannot just make a quick direct comparison with China or say, okay, let's just move the supply chain into India. But if those things can get addressed, and some of those things are slowly being addressed, that underlying growth potential of India continues to increase.
One of the things people say, well, you could actually apply that to all emerging markets. I'll talk about it as it relates to India, but just the opportunity of wealth creation, a rising middle class, favorable demographics.
Yeah.
You could apply that to a bunch of emerging markets. Where is that on your list of things? I'm going to invest based on that, because demographics are something that gets thrown around a lot.
Yes.
Look at the demographics. It's so much better. Does it always translate, though, to equity performance?
And I think it really came through when the Southeast Asian economy was growing, and then China growing, and people were starting to talk about the demographic dividend.
Yes.
And in in China's case, it was also capital, because we must remember that for economy really to grow, it's your growth in capital, your growth in your labor force. So that's your demographic dividend, plus then what they call multi-factor. That's just how the two interacts. And a lot of countries cannot get that capital to really grow. And that's private sector and governments investing infrastructure, but also general investing by the private sector. So a country like India has extremely good demographics. If it can get the private sector to increase their investments and build more capacity from that perspective, you're unlocking a demographic dividend. And for how we think about it is, for some of the countries where we could see that being unlocked, it is really interesting, and we would spend more time finding interesting opportunities rather than just giving it a cursory overview. On India itself, if we think also their what I call GNI, so GDP per capita, is about just over 2,000. So it's kind of on the lower end of a middle income category. And countries that really grow that GDP per capita from this low, call it 2,000-3,000, towards the 6,000-7,000, then they're still very much middle income. But we've seen the consumer growth during that period being really, really strong. And that's why India for us, as well from a consumer perspective, remain a very interesting destination. Also from a financial perspective, because this is also the period, if you grow through that development phase, where you see financial deepening.
Okay, so let's apply this to a stock. We got a question actually on Reliance Industries, the Ambani family. You can't get away from it, even if you don't follow business news. You probably followed the wedding and how much was spent there. But this coming from James Gordon McLean. I love the Indian market. Do you like Reliance Industries due to its breadth of interest? So it's all over. It's a conglomerate. And it was in some hot water, let's call it, in 2024. It was targeted by short seller Hindenburg. Hindenburg is now closed down shop, and Reliance is now back to where it was before the short report.
Yes. So again, from a holding perspective, it is one of our core holdings in India.
You own it, okay.
But given its vast complex, and that it is truly a conglomerate and probably the most prominent conglomerate, well, one of the most prominent conglomerates within the Indian complex, it is also a reflection of what's happening with the broader macroeconomy. So then I go back to my earlier question, or answer that right here, right now, we think maybe cyclically there might be a few hiccups. But I think for Reliance specifically, something that really interests us is they're talking about this year IPOing of their mobile business, the due IPO. And if that happens, and we've been waiting, and investors, not we alone, investors have been waiting for that, because then it's a beginning of trying to unlock some of this conglomerate in different value parts. And we think if they start doing that, because there was at one point also talk about the retail part, but it seems that's going to be well into the future IPO. But as they start doing that, then you start unlocking more and more value from this conglomerate. So yes, we like.
And is that a high probability event?
The due IPO, yes, that's a high probability event for 2026. Beyond that, everything is up in the air.
And do you need that to happen if you're going to continue to be a shareholder? Do you need to know that they can spin out these businesses?
No, that's not our primary reason for holding it. It is a really good operator. It has fingers everywhere in the economy, but where it's operating, if we think on the retail side, if we think then on the mobile side, if we think obviously on the energy side, they are really good operators.
And you feel, again, back to the issues of fraud and transparency, right? That was obviously raised by the short seller report. And I imagine you held through that period. And to boil it down, it was, as these things often are, aggressive related party transactions that are not disclosed. Do you feel, was that a fair report? And do you feel comfort around all these moving parts within Reliance?
So would I say a fair report? No, I think like any short report, they would overemphasize the other side. And some of that tends to be true. And with the report, there had been some truth to that, absolutely. But they're overplaying how important it is. For us, as an investor, normally when reports come out like that and we were caught offside on the report and we're holding it, there's two things. One, we're trying to assess the materiality and assuming that some of the more prominent points are actually correct. What is the materiality for the company as a whole? Also reputational side. But then also the other very important part is the response from the company. And how are they dealing with that? And then we normally take those two as two of the probably most important inputs to decide, okay, do we sell because of that report or do we think we can hold it through this volatile time?
And you decided to hold.
Yes.
And it worked out because
yes.
we're back. Okay, we've got another question. This one, we're going to Latin America. We're globetrotting in this, in the mailbag. Question on MercadoLibre. This has actually been a top idea from a few guests recently, not just global investors, but a recent value investor. Oh, that's what the question is about. A recent value investor on this show recommended MercadoLibre. What do you think of this stock? This one coming from Harvey.
So when I was thinking about top ideas, MercadoLibre had always been right up there.
It's like an Amazon for Latin America.
Amazon, but it's more than an Amazon because it's an Amazon, it's an eBay, because it kind of started off as an eBay in Latin America and then it turned into an Amazon, but highly successful Amazon. I mean, we can go into all its moats that it has created, localization. If we think logistics, they've created some really good moats, and then they have the fintech side. So they've brought that into the ecosystem. So really, really good company. I think longer term, it's absolutely a company that we want to hold. At the moment, it's struggling with some competition in Brazil.
From Amazon?
One, Amazon, but then also from Southeast Asia Sea Limited. So it's operating under Shopee. So the one is kind of trying to eat into MELI's market share from the bottom up, and that is Shopee. And then Amazon is already coming more on the Amazon level and coming down, trying to take some market share. So there is, in any market, we've seen that in China, we've seen that in India, when there is a bit of a market share fight amongst e-commerce players, it put pressure on margins. And you go through a few quarters where things might look a little bit, not dicey, but a little bit more difficult and challenging. But we think MELI comes through this very, very well. We've already seen Shopee becoming a little bit more rational. Amazon, not yet, but Shopee already there.
And I guess when you have those issues, MELI being MercadoLibre, the valuation matters, and you can't really call MercadoLibre a cheap stock.
No, it's not cheap.
So it doesn't fall into that bucket of like good valuation, emerging market.
I was surprised when he mentioned, I didn't listen to that podcast, that it was a value manager that's...
it was, yes. Don't worry, I raised the value question.
Okay, because no, it's not a cheap stock. But I would also say if we look at emerging markets, a lot of the times, if you look at the valuation, you would think, wow, that's really expensive. For us, it's the way we looked at it is kind of a GARP way, growth at a reasonable price. And often expensive valuation in emerging markets are not necessarily expensive if you believe the growth story. And this would be similar to MELI or MercadoLibre. If you believe they can continue to grow. I don't think they can grow as they did in the past, but we think overall the company continues to grow at a very, very good clip.
I'm so glad we got a question about this next company, because this is actually, when I first saw you speak, I think it was last year at a CI event, and I thought, oh, I want this guy on my podcast. It's about Pop Mart.
Oh, okay. Yeah.
And you've got a great story about Pop Mart, but do you want to tell us? A lot of parents will know what Pop Mart does because of the product. And what does Pop Mart make?
So if you don't know Pop Mart and you have a young daughter, you probably know Labubu. And that's the maker of Labubus, a Pop Mart. So Pop Mart really took the world by storm. Started obviously in China, it became really popular in China, but then expanded into Europe, into the US, where we've seen phenomenal growth rates. We think that, and actually last year, Pop Mart had been one of our biggest contributors to performance. So it was really, really great stock. But towards the end of the year, we sold out of Pop Mart because we just thought the story became very well known. The incredible growth rates that we've seen, especially from the Labubu side, became very well known also in the market. And we believe, especially with Labubu, we've reached peak growth.
Peak Labubu.
Peak Labubu. Yes, I think that's where we are. Peak Labubu. Then you suddenly have to ask, okay, but it's other IPs. If we think about Crybaby or Skull Panda, they're not, look, they're doing well, but they're not Labubus. And how can you replace the Labubus? And even with Labubus, they're trying to do Labubu and Friends, trying to clearly push further and further on the Labubu world.
Yeah.
But we think we've reached peak growth. The share price had come down. And at some point, I think it will actually make sense to again hold it at a better valuation. But for us, that was the reason why we've just stepped away from Pop Mart.
I mean, and you look at toy makers, Mattel, for example. I mean, they've got that iconic Barbie franchise, and they're struggling as well. So you can have that kind of one hot toy, but even with a good ecosystem, it can be difficult in this environment.
That's it. I mean, another example would be Hello Kitty.
Yes,
that they've done the same, and they've really tried to expand beyond Hello Kitty. And don't ask me the rest. I don't know the Hello Kitty family. But
who owns Hello Kitty?
Japanese company, Sanrio. Thank you. Yes, thank you very much.
Thank you, Georgine.
Yeah. So, but similarly, Hello Kitty was working very well, but finding that second, third, fourth IP, that even if they're not as great as your prime IP, Hello Kitty or Labubu or Barbie, can it be enough to keep growth going? And some companies just find that really difficult.
Yeah, the Sanrio chart looks a lot like the Pop Mart chart. It has come off. I do want to give you a chance, though. The part of the story that I loved about Pop Mart when you were telling it last year was what you mentioned earlier in the show, kind of boots on the ground and how boots on the ground is important. You sold at the end of the year, maybe not at the top, but I assume you still made a lot of money on it because you were very early to the Pop Mart story. What was the boots on the ground edge that you had on Pop Mart? Not
your traditional research. Basically, the person that's covering for us the consumer side in Asia, she had friends starting to call her in Hong Kong, asking whether she can buy this little doll called Labubus. And she was like, yeah, they're available. And they're like, oh, how many Labubus can you buy? And then she bought Labubus for them. And when she went back to China, she gave them. And she's like, why did I have to buy this? Because it's a Chinese company. And they're like, it's not available. We can't get it in China. That's how popular it was. And that actually triggered for her that a question. So what's going on here? And then she realized, but this is slowly but surely expanding beyond China. In China, it's very popular, but it's going further than that. And that's how she got onto that trend actually fairly early on. Right. And then when she were looking at it, and then the sports stars that started wearing it on their backpacks, if we think tennis stars, I think on the NBA side, there were a few wearing it. then
I know people were attaching it to their phones. Adults had it. There's like clothes, Gucci clothes, all these things you could put for your labubus.
Exactly. And that's also coming back just how we think about research. Why, if we think about our emerging market team, everyone there has at least 10 years of experience. We want people to not only be analysts, so analytical thinking, because look, AI can probably soon do some better analytical thinking than analysts.
Yeah.
But it is that critical thinking that's so important. And here was a very good example where it was something personal, but the critical thinking part of it was like, oh, but wow, how does this translate to investments? And maybe this is a good investment. Turned out to be a great investment.
Well, I think we've hit a record for an investment podcast. The number of times we've said la boo boo. That was a great conversation. I want to shift us to what I think will be another great conversation. We got a question on Toto, a Japanese stock. An activist investor has taken a stake in a Japanese stock, and it actually made news this week. And I wrote it up because I loved this story. And it was, I think the headline was like, activist investor takes aim at toilet makers, says it can play in the AI booth. Which is basically, so if you've ever sat on a Toto toilet, I mean, it's like a very elevated experience. They've nailed toilets. How does that translate to what they can do in AI?
Look, I could say we're not deep into, or we're not following the toilet market that deeply. So Toto itself, actually, I do not have an opinion on the stock per se.
Yes.
It's funny what you're saying about AI. Every company is now trying to say somewhere we bring some AI into it. But I think it speaks to something much more fundamental that we're seeing in Japan and a change in Japan. Previously, activist activity, and especially foreign activity, had been frowned upon and often blocked by the government. Our last one would be Couche-Tard and Seven Eye. But we have now seen both the government and the policymakers and then companies starting to realize that activist investors are not necessarily a bad thing. They are another shareholder in the company and therefore have a share to say something. And it was interesting last year when I was in Japan again, speaking to some of the policymakers. I actually asked one of the policymakers, what's your view on activist shareholders now? And they said, well, if they can unlock value in the company, we support that. And I almost fell off my seat because for a Japanese policymaker to say that. But I think Toto would be a good example where if an activist investor comes in with a reasonable plan to unlock value, now investors are paying attention because they know the company might either accept that, or if they have to defend it, they have to defend it in an economic, financially viable way.
Yeah, and in this case, it's that they have a chip making business. That very little known chip making business, I assume, is part of making their toilets. And the activist is saying, "Hey, have you thought about what that could do for AI?" Anyway, I'm glad that we brought it up. I've been to Japan and I use their toilet, even a public toilet. It's like such a beautiful experience. Anyway.
It is.
Okay, let's go to real luxury, LVMH. The stock is down 25% over the past year. Such storied brands, luxury, but absolutely getting kind of run over. What do you do with an LVMH?
I almost want to say, what do you do with luxury? Because, I mean, whether it's Richmond, LVMH, they kind of look the same. Some have some very stock specifics. If we take Hermes a little bit better holding in, but it is more what's happening to luxury. And then you have to say what's happening to China, first and foremost, and the US. And we know in China, the consumer is at best okay. It's not in the doldrums, but it's not the kind of consumer that we got used to through the 2010s, even the period 2010 to 2020. It was really aggressive spending, aggressive uptrading into the luxury space. So for the luxury companies, the China growth was really important and continues to be really important. And that have cooled down somewhat. And then there's the US growth and US luxury spending, which last year was actually decent, but there's some questions about US economic growth this year. So you have
not if you look at the GDP now forecast, but it seems like where's the I do hear you on that. The job growth is not there, and it's driven by AI.
Yes,
AI doesn't need an Hermes bag.
Exactly, and look, they do talk about the K economy in the US, so the upper end still spending a lot. But if we look at the numbers coming out of the US, it's not crazy growth numbers for the luxury side. It's good numbers, but not crazy growth numbers, which means your swing factor, again, is China. And that's why we've seen last year as well, the volatility in the luxury names. The moment when things started looking a little bit better in China and there was talks about more stimulus coming through and maybe the consumer could do a little bit better, we saw the luxury names rallying really hard and then coming down again. Right here, I think it obviously offers better value, but it's more a view on how one sees these different markets and especially then the China market picking up again. And there I'm a little bit more cautious on the Chinese consumer, also the Chinese luxury consumer.
So that's your trigger. That would be your trigger to buy, seeing better consumer numbers out of China.
Exactly. And that was also why either one could be negative and say why we missed that last cyclical rally or why we didn't participate in that rally. Because again, out of the Hong Kong office, the same person that was covering Labubu, she was saying...
She sounds amazing.
She was saying, because I often travel into China as well, and she was just saying she does not see the luxury demand coming back strongly. So she's not willing to say, yes, from that perspective, let's participate in that luxury rally. So yes, we didn't participate in that short rally, but we neither held the stock while it was coming down. But right here, right now, as I said, it looks much better, but we're keeping an eye on that Chinese consumer. That's for us the trigger.
Not ready to pull the trigger yet, but let's find out what some of your high conviction ideas are, and we'll get into your pro picks. Pro Picks is brought to you by ATB Financial. With over $100 billion in assets, ATB Financial is powering possibilities for more than 843,000 financial services clients. ATB Cormark Capital Markets is a leading North American investment firm providing holistic corporate and capital markets advice and full-service financial solutions. Visit atb.com/inthemoney for more information. Okay, so you've brought 3 international ideas for us. And the first one has already done quite well. It is Samsung. Talk to me about the dynamics, because in many ways, Samsung has kind of gone parabolic since the summer, thanks to
memory. And we're back to the AI trade. It is memory. It is the global AI trade here. Interesting. We were well ahead on the memory trade. So we own both Hynix and Samsung. So for those that are not familiar with the memory makers, with AI and everybody focusing on NVIDIA and the chips that need to, the GPUs that need to be very powerful, you need, if we think about transfer of information and what they call that latency, you need that, and that there you need memory. So we had the emergence of HBM, high bandwidth memory. And basically that's dominated by 3 players, Hynix, Samsung, and then Micron in the US, with Hynix being the number 1 player. So we were overweight, but then kind of, and now I have to guess, it was like the middle of last year. We started taking a contrarian view on Samsung and added even more weight to Samsung. Because
it was under pressure.
They were under pressure because they were falling behind. The irony is, right at the beginning of HBM, they were leading. And they were seriously falling behind. They struggled. At that time, it was the HBM3E. That was the latest, newest version. They struggled to get the certification from NVIDIA, which means that NVIDIA is fine with your product. You can start shipping. Whereas Hynix had none such problem. So the market started doubting that they can keep up with this race. And there were already some restructuring happening within Samsung, recognizing this problem. There was more restructuring later in the year on management to just try and get their technology advantage back, because they were always playing, we're so big, we've got this moat of being a massive company with big balance sheets. Now it is about how quickly and how fast can you develop and stay ahead. So in the meantime, so that's why we thought they will come back and they will get the certification. They surprised us. Not only did they get a certification, but then they said they're going to be the first on market with HBM4, which is new generation. And they just very recently announced they're going to start a mass production of HBM4. So they've moved from being a laggard to, I won't call them ahead of Hynix, but the pressure is now on Hynix because Hynix is also busy with their HBM4. But to come through with their HBM4 and show and prove that it's actually better.
And we've got a stock that's now up 260% over the past year. Still only trades at 8 times earnings.
Yes. And that's why we really, Hynix, we are concerned about valuation. But then one has to say, if you look at some of the other AI stocks that's working, but we are talking what's working, what's not working. But winners are trading at really expensive valuations. Not all of them, but a lot of them. And memory had currently been the focus for investors. So Samsung trading significantly cheaper. You could look at that from two perspectives. You could look at the total one, but it is a conglomerate. So there will be a conglomerate discount. The other way we love to look at it is to say, what if we break it down into components? And we say, on its chip making side, it's not exactly TSMC. It's good. It's a good second player, but it's not TSMC. So let's give that a big discount. Let's give it a discount on the phone side. Some would say, no, it should be the same as Apple, but we say, let's just be reasonable, give it a discount on its phone side. I think on TV, you can give it actually a little premium. And then you say, what if it can reach Hynix, which is a pure memory player, reach that valuation? Then if we start doing the sum, sum everything together, we still add a significant, or we get to a significantly higher valuation. So we're
How
talking
much higher?
20-30% for us is quite doable. I think probably the biggest risk here is execution risk, because they said they can do mass production HBM4. They saying they are going to come out with HBM4E in the second half of the year. Can they do that when Hynix come out with their HBM4? Is that a better memory chip than? And that will be the real question. So I think execution really important. Then there's a few other things that might work for them. They bring out probably this year the threefold Samsung. I think it's going to go the Galaxy Z. Maybe that helps.
That's not why we're buying the stock.
That's not why that would be for us like added bonus if that really takes off as a popular. But we're buying it for its memory side.
How long do you think the memory cycle lasts? I know that's a big question. As they rush to produce, what's going to happen. At some point, it will be oversupplied.
Yes. I think at least for a number of years. But we're talking on the HBM side, because it's basically
high bandwidth memory.
The high bandwidth, because the other side, NAND and DRAM, at the moment, shortages, so they have pricing power, but that part of the market, very, very cyclical. So yes, everything is working on the memory side. And we know that part can very easily, the moment if they expand capacity, because if you look DRAM, then you're suddenly not talking 3 players. You're talking a multitude of players. So, but the HBM side, we think that's really going to be the focus. And similar to a NVIDIA or a TSMC on the foundry side, that's going to remain a very important driver.
Okay, so, and you still see upside with Samsung. Let's talk about your second idea, which is Alibaba. And this one just has struggled. Other tech stocks have reclaimed their 2021 highs. Not Alibaba. It's definitely lifted over the last couple of years, but it's almost half of what it was since the pandemic. Why do you like Alibaba here?
Look, it's interesting that you're calling it a tech stock, because that's actually why we like it now. It had turned into a tech stock. The majority, half of its business, or more than half of its business, is still the e-commerce business. And it struggles over the last number of years. Had been regulatory issues. They had a fintech side, and they ran into problems there on the government side. The government clamped down on a lot of the e-commerce side.
We didn't see Jack Ma for a while.
Exactly. That all played into this falling out of favor with policymakers, which had been really important. And then they had their little cloud business carrying on, and they were trying to pump it up, but investors weren't overly interested.
And it's not like Amazon's little cloud business.
No.
Amazon is a dominant cloud player. Alibaba, not so much.
And Amazon has AWS, and that's a very recognized part of Amazon now. It's e-commerce, AWS, cloud. But we must also remember that China is in the early stages of their AI development, cloud development. And that's the difference. We had the first shot over the bow with DeepSeek in January, February last year. And then it cooled down. And then the second half of the year, where we saw some of the applications, AI applications coming through, but then it became clear China has their own AI moment coming through. And with that, the cloud moment. And that's where Alibaba really comes through. It's a full stack, what we would call IaaS, so infrastructure as a service, a full stack provider. Nobody can really compete with them. I mean, there's Tencent. Tencent has stumbled a little bit on this now at the moment. So they are really the go-to if you're looking for a full stack infrastructure, AI, cloud provider. And that is growing very rapidly.
What kind of upside do you think? Does it go back to where it was during the pandemic, higher?
I think eventually it can go back to where it was, because it's now the hope that the real growth is going to come from the cloud business, that it start looking eventually like an Amazon, where it's cloud and e-commerce rather than e-commerce with a little bit of cloud. How
much do you have to think about the risk that, what if it falls out of favor again on the part of the government, right? And they just, that's something that, who knows what could happen, but it could just as easily happen as it did a couple of years ago.
I think two things. One is the Jack Ma moment, that even if you're CEO, chairman of one of the most powerful companies, you still operate within a country. So you have to respect the country's framework. And I think companies have learned that. We've seen Tencent, and that must have been around 2017 that they've gone through that same moment. And then they learned to operate within the framework. And within the framework, they have then free reign within the framework. So I think that's the one part that they've learned how to play that. And I think personality-wise, we wouldn't have a senior official or a CEO really starting to criticize how behind policymakers and regulators are behind the curve.
So they understand. Okay, so you have two tech plays, Samsung and Alibaba. We're taking a little bit of a turn here with your third pick, Vista Energy. Talk to me about that.
Totally different, Vista Energy. So in the energy world, it's not really a contrarian play, but there's a number of things that would kind of push it towards a special situation.
Is it oil and gas?
Oil and gas. It is actually shale oil in Argentina. So you could see the wrist holding the different things.
All my flags are going up.
Yes. What you have here is a company created in 2017. It's an Argentinian operator. The management came from YPF, which was and still is the big oil company in Argentina. But things that have changed. One, they were able to start unlocking the potential of shale gas and shale oil in Argentina, which they still have, they have massive reserves, but a very complex rock structure. So just lateral drilling didn't do it for them. And as in the US, they've developed a vertical drilling and multi-stage vertical, they can literally follow the rock formation down. That unlocked the whole Vaca Muerta area in Argentina. So suddenly they were technically able to take the oil out. At the same time, over the last few years, or not the same time, a few years later, we had the political change in Argentina, where we get a government that are trying to bring, and I'm saying trying because that is another risk, trying to bring Argentina back on a stable footing from an economic perspective, but also from a policy perspective. So you take those two things together and you pick a pure player in Argentina, pure E&P energy player, who had a few really good wells, but they're expanding very aggressively, really good operator, driving down cost, if we think about well cost or even lifting cost.
Vista.
This is Vista. Mm-hmm. So very good execution, what's really sitting down with them and chatting also with them, they are very rational what growth looks like. It's not growth at every cost. We grow we buy additional wells, or we'll add new wells if we think we can get the productivity.
And they've done a few recent deals, big deals.
They've very recently done a fairly big deal. Again, a block just next to their own block. So again, they remain very concentrated. So for us, it's this that really excites us.
And what kind of crude is it? Like, is it refined locally?
It's the shale oil that gets shipped out. And that's part, again, with, if you think about some of the other players in Argentina, the oil players, a lot of their oil goes to the domestic market. For Vista, already 60% heads outside Argentina. Every additional barrel of oil for them goes outside, which means export pricing parity is basically they can
get better prices.
They can ask the international price. So that, and the one thing I do want to just also their efficiency of their wells. And this has to do with the cost of well, how quickly it can produce. We already see Vaca Muerta. If you take 3 months into it, their wells are more efficient than what we've seen in the US. And then on top of that, you have Vista.
And contrarian because of country risk?
A contrarian because of country risk, yes.
And did any of the Venezuela situation change their dynamics, their access, their competitiveness?
Not so much. I think longer term, it's more a question on where the oil price will settle. If we see Venezuelan oil coming into the global market, obviously that could pressure the oil price. So there is that risk. Now, at the same time, for Vista, their break-even rate is $45 a barrel. So it is still lower than even these prices that we're currently seeing. So they can continue to operate. But yes, the higher the oil price, the better for the company. And
just because they're growing via they're growing via acquisition in part, is debt a problem? Or do you think it's manageable?
That's the other beautiful part of the company, is they have debt ratio of 1.36, so call it 1.4 times. For an E&P, very low debt ratio. From this point forward, they say they're going to be self-financed. So cash flow positive, going to repay debt, and then any expansion they expect to do that through own funding. So very clean balance sheet. Actually, one of their 3 pillars is a strong balance sheet going forward. They want to keep a strong balance sheet.
Matthew, it has been such a pleasure. I learned so much. Thank you so much for expanding our minds and our perspective just away from Canadian and U.S. stocks. I appreciate it.
Again, absolutely my pleasure.
That's Matthew Strauss joining us from CI. Don't forget to tune into our next episode. Whatever happened to ESG investing? Is it dead, or is there a quiet renaissance? We are going to be speaking with Amber Fairbanks of Impacts Investing. If you've got any questions, email questions@inthemoneypod.com, and we'll see you on the next episode.